Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at CHEWY and do a full stock analysis on it. That is ticker symbol CHWY. Been a very popular stock lately, but it had a huge drawdown after its most recent earnings report. So I wanted to give you my thoughts on where I see it going and break down the fundamentals to see if it is presenting a good opportunity for a buy. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Hit the little bell so you get notified every time I post. There's also a link down in the top pinned comment to my Patreon account. Come over and join the family. We've got an awesome community over there. You'll get access to the private Discord where we talk stocks. You'll be able to check out all my portfolios and see exactly what I invest into. And then anytime I buy or sell a stock, up to the second I do it, I send it out so you can follow along. I also send out a lot of swing trade setups, which is absolutely the most valuable aspect. We've had a ton of winners lately, and some of the members are making fantastic money. So if that's something you're interested in, come over and join us. I know you'll get a lot of value out of it. Day one squad, I love you guys. Thank you for your support. Before we get started though, guys, I just want to give a quick shout out to Daniel. Thank you so much, man. He is the first ever Godfather tier. That is a $50 contribution to the Patreon every month. So Daniel, you are the real Godfather. Give him some hype down in the comments. Let him know how much you appreciate it. Welcome him to the family. So thank you, Daniel. But guys, I want to get started. I want to talk about CHEWY. This is like I said, very popular. It has had a big drawdown. We have seen this earnings season beat down stocks uncontrollably if they miss guidance or post lower numbers. Now, our job as investors is to find those stocks that are being mispriced by the market, where either they have a big overreaction, big drawdown, but there's still enough value there that we can ride that back up to where it should be priced. So we need to identify if CHEWY is in that position or at those levels that make sense for a long. Now, guys, one thing I want to say, this is, again, a top-down surface view analysis. This is not something that I have done extensive full DD on. We're just taking a look at the overall fundamentals to see if this is a good opportunity for A, long-term high conviction hold, or B, a swing trade that we can play the volatility and ride the ups and the downs for short-term profit, or C, something we want to stay completely away from. So let's get started. First thing I want to look at, guys, is the earnings report. This is just, again, brief overview. As you can see here, they had Q2 non-GAAP EPS of 2 cents, which beat by 3 cents. The GAAP EPS was negative 4 cents, which was a miss by 3 cents. Now, the EPS and the revenue was not bad, guys. As you can see, the revenue was $2.16 billion. So it's a good sized company doing a lot of revenue. They grew that revenue by 27.1% year over year. So really nice to see that growth there. Now, they are an e-commerce company. For those of you guys that do not know, CHEWY is like the Amazon of pet products, all different types of pet products, and they do a lot of subscription-based service where, say you've got a couple of dogs, you order dog food, they send it out to you every month, you just pay them, and everything, gets sent to your home. Now, they do a lot more than that, but those are one of the things that I did look at that I did like and I thought was very intriguing, because a large percentage of their revenue does come from that subscription model, which in my opinion is very important. I love subscription, reoccurring revenue-based companies. The revenue was a miss though by 10 million. But when you're doing $2.1 billion, 10 million is this much. So not a big concern there, nothing to be alarmed about in my opinion. But what is to be alarmed about is the adjusted EBITDA. As you can see, it was 23.3 million versus a consensus of 34.8 million. But the margin, they only posted 1.1% on their adjusted EBITDA margin when the consensus was 27%. So guys, that is a massive, massive miss there. And that is something you should not just kick to the side. You definitely want to look into that if you are considering investing into this company. Again, this is not DD. This is something that I would want to look into, if I was to buy it. But that is something that I throw it up there as a check to, something that's a little weird. Definitely want to, find out more about and see why that happened. But now let's jump into the overview, guys. So there's a couple of things that we look for here. So first thing we look at is volume. As you can see here, guys, the 7-day volume was 8.9 million. where the average 3-month volume was 3.4 million. So like I said, the stock's been very popular lately. That's probably why you're getting such an influx of volume over the last 8 days versus the last 3 months. So more than enough volume there, definitely liquid enough for my my liking or my taste, no issues there. As you can see here, guys, the 52-week performance, it's up 24% over the last year, even after that big drawdown after their most recent earnings report. So, the stock is definitely moving and trending in the right direction. Next thing here, guys, is shares outstanding. As you can see here, 417.76 million, so a decent amount, nothing too bad though. Held by insiders, not even 1%. So that is something that, is a little bit, something to think about or something to look into. I do like to see when companies have at least, 5% ownership in the company. Historically, companies with a lot of insider ownership typically perform better because they care more. Coming from a business owner myself, I've been in those positions where I don't own much of the company or any of the company, and I just don't perform like I do when it's my own. So food for thought. And I'm sure business owners out there, you guys know exactly what I mean. Now, held by institution, guys, almost 20%. So there's obviously institutional, interest in this company, which is, good to see. Obviously, I don't really care what institutions invest into, but it is good to see that smart money is investing into it, for say. Now, as far as the market cap, 32 billion. This is a big company, guys. This is definitely not a small cap company. We need to identify and see if $32 billion is worth paying for this company. Now, after looking at the market cap, we always want to look at the valuation metrics. As you can see here, guys, the PE ratio was pretty much, just call it negative, right? I mean, 3,400. It's not even a PE. You want that to be around 15, 20, 10, depending on the type of company you're investing in. Now, this is a growth stock, so you can award it higher multiples than a traditional value stock. It is e-commerce, so they typically should have higher margins, things like that. So companies like this should get a higher PE, but definitely not 3,400. As far as price to sales, it's about 4, so that's not bad. I actually thought it was going to be a little bit worse than that. You typically want that price to sales to be as close to 1 as you possibly can get it. Guys, that's price to sales. So where price to earnings is their price per stock versus their actual earnings, net income. That's price of stock versus the actual sales revenue of the company. So you want to pay, 1-to-1 typically, but I have multiple times invested in companies that are much higher than 4, so nothing to be concerned about there. The price to cash flow is what we look at. If you're familiar with the channel, cash flow is absolutely the one thing that I look at and is I hold more weight than any other valuation metrics. As you can see, guys, that's almost 100, 98.8. Definitely a little high. You're definitely not getting this company at a deal or a discount. Even after the big drawdown, this company is at a premium, no doubt. Like, I would say a little bit too much of a premium from just looking at this so far, but we'll have to jump in and kind of take a deeper, look. So next thing, guys, gross profit margin, 27%, really nice margin there. Return on assets, about 0.5%, no return on equity yet. EBIT margin, not even 1%, net margin, not even 1%. So definitely something that you would want to see those start to come up over time. Not too concerned with the net margin because it is a growth company and they're doing a lot of things to rapidly grow the company. So that could lag behind for a few more years, but I would like to see the EBIT margin come up a little bit and the gross profit margin looks great. So as you can see here, though, revenue growth is about almost 40%, 37.4% in their trailing 12 months, which is fantastic. If we can continue to see them grow at almost 40% year over year while doing $8 billion a year, that is very good to see, guys. Now, let's jump in and take a look at the income statement. This is where we're looking for revenue growth. We want to make sure that the gross profit is growing consistently. We also want to make sure that the cost of revenue is not growing faster than the actual revenue. Then we will take a look at the net income before we jump into the balance sheet. As you can see here, guys, from 2016, $900 million, $1.4 billion, $2.1 billion, $3.5 billion, $4.8 billion, $7.1 billion, and $8.1 billion in their trailing 12 months. So this company is growing revenue very consistently and very quickly. So not only is it growing consistently, but it's growing quickly. If we take a look at the year over year growth, you can see here, guys, 59, 46, 67, 37, 47, and 37. So they're averaging a little over 40% a year, which is very nice to see, even when they're doing multiple, almost $10 billion a year. It is very hard to do that, for a lot of other companies. Now, as far as the gross profit goes, same thing, guys. 149 million, 250, 367, 714, 1.1, 1.8, and 2.19. Again, if we take a look at the percentage of revenue, you can see here that it was 16% of the revenue in 2016, but it was 27% in their trailing 12 months. So their gross profit, guys, is going up every single quarter and every single month and every single year since 2016. So very, very good to see, guys. So that tells us that the cost of revenue is not growing as fast as their revenue, and their gross profit is growing faster than their revenue. Perfect. That's exactly what we want to see. So based off of those metrics, guys, that's absolutely justifying a higher valuation metric. Again, I don't think it justifies that much of a valuation metrics like we've seen, but nonetheless, very impressive to see there. Next thing is net income, guys. As you can see here, now this is what I like. They were losing $100 million back in 2016. They did get a little bit deeper. They went to 167 in the negative, 338, but then they started to turn it around in 2018, and they just turned positive in their trailing 12 months, guys. Now, I don't know how they'll end up at the end of the year. Will they end up in the negative? Does the end of the year come around and the fourth quarter is where all the expenses come in? I don't know. That's something you would have to look at on a deeper dive, but very impressive to see that they're, in the positive in their trailing 12 months. Now, is that sustainable? Are they hitting that inflection point where they're going to continue to stay positive and push to, much higher numbers in the coming years? If they are, that's something that is very, very sought after, within a company like this, because as the time goes on, the valuation metrics get better and better, depending on what the stock price does. Again, I would like to see the stock price come down based off of what we've seen, but nonetheless, we definitely want to jump in and take a look at the balance sheet and then the cash flow to get our definite answer. Now let's take a look at the balance sheet. What we're looking for here, guys, is total current assets versus total current liabilities. As you can see here, the total current assets are about 1.4 billion, where the total current liabilities is 1.5 billion. So they're definitely in the negative. They couldn't sell off all of their assets and pay off all of their debts, which is something I don't like to see. But again, you would have to jump in, take a look at exactly why that is, because a lot of the times, you could see expenses on there that are only carried for 1 year or whatever it is, or negative debts on their balance sheets. You'll just have to take a look. Face value, though, definitely not where we want it. We want to see that opposite. We want to see much more total current assets than total current liabilities. As far as outstanding shares, we want this number going down, which is actually very, very consistent. The stock isn't really that old, but they really haven't done much share issuing in the last 3 years, which is exactly what you want to see. You don't want to continue to get diluted by a company, and they are doing nothing of the sort. Very, very minuscule at that. So we really want to see them start to buy back shares. That's what I would like to see, and that's one way they could start to get their valuation metrics down, is if they started to buy back shares, but they just don't have the assets on hand to do that as of today. Now let's take a look at the cash flow statement, guys, and then we'll jump into the chart and we'll wrap it up. We'll jump into the intrinsic value chart, get the price prediction on it. Or what we want to pay for it. Now, as far as the cash flow statement, guys, for those of you guys that do not know, the way that you find free cash flow is you go to the cash flow statement, you take your cash from operations minus your capital expenditures. Now, I like to get 5 years divided out, get an average, but I don't always use 5 years. For example, this is a really good example, guys, is what I'll typically do. As you can see here, they did 7.3 right here in cash from operations back in 2016, but ultimately their free cash flow was negative because they had too much capital expenditures. They really didn't turn it positive until 2021, last year, essentially last full fiscal year. So what I'll typically do, because we have like a negative one or two here, I will only use like their last fiscal year and then their trailing 12 months and do like a 2-year average or a 1.5 year, or I'll just use their trailing 12 months. In this situation, I'm just going to use their trailing 12 months because it's much better, and I want to give them the benefit of the doubt because their valuation metrics already look so expensive. So as you can see here, guys, in their trailing 12 months, they've done 324 in their cash from operations minus 124 in their capital expenditures. So they've done about $200 million in their trailing 12 months in free cash flow, which is much better than years previous. As you can see, last year they did like, $2 million, almost $3 million. No, about $2 million. The year before that, they did negative. So they not only are positive on net income this year in their trailing 12 months, but they're positive in free cash flow by much more than they've ever been. So very, very impressive. If they can continue to do that, this company could see much appreciation in the coming years as long as they can continue to grow at the rate they're growing at. So everything looks good as far as the growth rate, the free cash flow, the net income. It does look too expensive though, but the next thing we're going to look at will tell us how much it's expensive. How much should we pay? How far over the line is it? As you can see, guys, this is a simplified version of a discounted free cash flow sheet. Essentially, you come in here and you put your metrics in, and then you make assumptions. So this is a much simplified version of a standard DCF. But I really like the way this works. So as you can see, I put in all of the metrics. Now, this share price was based off of yesterday, $76.75. I haven't even checked it today. Put the shares in outstanding, most recent revenue, most recent net income, and most recent free cash flow. Now, those are all for the trailing 12 months. Now, as far as the growth metrics, I just did exactly what they're doing today. As you can see here, for the next 5 years, I put 37%. That's how much their revenue grew, in their trailing 12 months. Now, could I up that a little bit to around 40? Yes, I could. So let's do that just to kind of see what happens, because as the 37, it is putting the price lower than where it is today. But again, want to give them the benefit of the doubt. Terminal growth rate, I just put 5%. That's standard. Now, as far as the net income margin, that doesn't really matter for the discounted free cash flow sheet. They're doing 1%, so I just put that in there. Now, as far as the cash flow margin, they're really doing about 2.5% as of today. I put in 3% to give them the benefit of the doubt. As you can see here, guys, I am getting an intrinsic value per share of about $43.80, which is 43% downside from current levels. So the stock certainly looks overvalued, in my opinion, from these current levels. If we change that growth rate back to the 37 from the 40, you can see here that it goes down to $39.50. So right around that $40 mark, which honestly sounds much better to me. I think $76 is way too overpriced for the company. And I think the price above that before it sold off after their earnings report was much too expensive. Now, I do want to preface that by saying, guys, in this market that we are in right now, it is not uncommon to see growth stocks with crazy valuation metrics. And I almost feel that as some value investors only will buy a stock if the valuation metric is where they want it exactly, like a 15 or a 10 or whatever. I am willing to buy stocks with higher valuation metrics, because I am willing to buy it on a shorter term basis. Now, if you're buying this for the long term, you're going to dollar cost average into it, then I would recommend waiting until you get down to that price, setting an alert, moving on, and not settling for a stock that is way, far above your valuation. But for the short-term volatility, guys, I feel like there's a lot of missed opportunity in some value investors that will only invest in stocks that are exactly where their valuation meets. Now, I like the disciplined approach, but we may look at the chart and we may see this has a ton of upside in the short term, maybe even, 3 to 6 months. I'm not just going to sit by and not take that. I'm going to capitalize on an opportunity like that. Just like the Roblox video, guys, way too overpriced for me to invest into, but we identified a bullish Gartley on the daily chart that was implying tremendous upside, and we already hit the first target and, are doing very well with that trade. So I just wanted to preface that, guys. Just because the chart or the sheet is saying that it's way overvalued doesn't mean that we still can't take a position on it as a trade. But as of today, I am not looking to buy this stock as a long-term hold until the price comes down, quite a bit. So now we can move some of these around, guys. So like if we were to up the cash flow margin from 3% to like 7%, that puts the price up there at $92. So that's the assumptions you have to make. If you think that the cash flow margin is going to go up tremendously, if you think the gross rate is going to go up, if you think they're going to continue to do what they're doing, then maybe the $72 is, $75 is fair value for you. Those are assumptions you have to make. But again, for me, little too overpriced today for a long-term hold. But now let's look at the chart. So the chart actually looks good, guys. What's funny is I identified this big momentum shifting structure, inverse head and shoulders, call it whatever you want, last week, and I was looking to take a short-term measured move trade on it. Now I always wait for a back test on a setup like this. I don't ever take it on the breakout. I usually wait for a breakout, a back test before I go long. I didn't end up taking this trade just because there was others out there that were presenting more upside. It wasn't showing exactly what I wanted. But as you can see, the trade did, well, not necessarily failed as of today. I would have set my stop loss below the structure, so I would have been stopped out, but nonetheless, I didn't take it. Didn't even send it out to the Patreon. I was just mapping this on my own. But I do want to point something out. Even after the sell-off, guys, there is no damage done technically as of right now because it has not made a lower low than the previous discernible swing low. I really like to see this momentum shift here, guys. And as you can see, we've got bullish divergence going in to the lowest low before we had that reversal, which is exactly what we want to see. The other thing I want to mention is we did have the lowest low. Then we had the spring, the back test, the next spring, the back test at the top of the range. So when you plot these demand zones, guys, you can see, or these inflection points, you can see where you get the first test at the bottom of the zone, you get the second test at the top of the zone. So that little higher low right there is a very good sign of momentum shifting, accumulation, more market participants own the stock around these areas than back here at these areas. So one thing I want to point out here, guys, the RSI is dumping quite substantially. It's down in 32. That's the bearish control zone, no doubt. If we break this inflection point here, guys, we could see much, much lower prices. There's two scenarios that I actually think could potentially play out here. Right now, I wouldn't take this stock as a buy or a trade because you've got to wait and get confirmation that it is going to hold these levels. If it holds these levels, it's making the same low as this low, and I would absolutely want to see it come up and give us some type of confirmation that it is going to continue moving up to the upside. I really liked how the moving averages were coming right here below as this stock was testing these levels up here. If the earnings wouldn't have came out and it wouldn't have gapped down here, it would have been such a nice setup, guys, but that's how the stock market goes. You get those earnings reports, you get those sell-offs. Now, there's a couple potential situations here that I want to identify. One, I'm actually really hoping happens because it would set up a nice trade. The other one, it doesn't really matter to me if that happens or not. It would be something that I would just move on. The first one would be a bearish Gartley pattern, guys. So let's just hypothetically say from these levels right here, because it made a 61% retrace and now it is holding support. So let's say it reverses right here and it comes up to the 886, which would also be confluent with that initial candle high close from back in December. If it does that though, guys, we could be absolutely seeing a rally from these levels that it's currently at. So we could see it bounce here and run to that C to D leg up to the top of the range. Now, this is a bearish pattern, so we could see it sell back off. But in such a bullish uptrend, a long-term uptrend like this, you absolutely could see it sell off, back test this level before running to much higher prices. Now, this is one scenario. The other thing that could happen is this could also go all the way down to an 886 because the BC projection is a maximum of an 886, a minimum of a 382. So it is meeting the minimum requirement where it is currently at, but it could come all the way down to the 886, which doesn't make much sense. If anything, I think it would reverse here if it was going to make that pattern. Again, that's just in development, totally speculation, just wanted to throw that out there. The more likely scenario and what I would actually really like to see happen, I'm going to go to the 3-day chart to make it a little bit easier to identify here. But as you can see, we could potentially be getting a bullish Gartley pattern that is forming right now. So you come down, you made the about a 60% retracement. This could absolutely, come all the way back down, especially based off of what we just saw with the intrinsic value sheet, guys. Putting that price at around $40 for a fair value. Look at where that lines up, guys. That would be the pattern completion zone at a 786 of the X to A. That would also put you confluent with the C to D leg at a 1618, which is a maximum requirement for the bullish Gartley. Guys, if it held there, if it came down, the pattern completion zone would also be at that high from inception. So it would come down, retest a critical inflection point where it has held support and been rejected in history. If that happened, guys, we could see massive appreciation from these current levels. This is exactly what I would want to see happen. If we jump back to the daily, I just drew it on the 3-day to make it a little bit easier, but that is where I would be a buyer of CHEWY, not where it is today. Now, you may catch bids right here and run right back up to the top of the range to retest it and form that bearish Gartley pattern. If you form that, you're probably going to sell back off at least to a little bit of a lower level. You may not, though. It's in a bullish trend. You may just blow right through it and keep on running. I actually think, though, if you break these levels, there's a good likelihood you're going to see this D point down here at the 786. Now, you didn't quite make a 61 percent retracement on the A to B. So you very well could be actually making a bat pattern and going to the 886, which would be down here, which would also be confluent with the initial low from inception. So either way, guys, I'm a buyer. If it comes to the 786 and shows reversal pattern, I'm in. If it comes down to the 886 and shows reversal, I'm in. If it doesn't and it reverses here, I'm just going to move on to a different stock. So that's what I see, guys. Again, from these current levels, there's so many things that can happen. The reason why I would really like for this to happen, guys, is because look what happens when you get big bullish Gartleys that form on the daily over the course of huge structures like that. You get big price reaction. Those are those deep value perceived areas that you want to buy stocks in. They get the big run up. You get an 80% retracement. You're essentially buying it at a discount of 80%. A bat would even be better, almost a 90% discount. Same thing with Fastly. This is kind of a bonus for you guys that watch the channel. This is one that's in development, guys. We just had a massive bullish Gartley, textbook Gartley, 618, 787, 786. And then we got the first low, then the second low, and we got that big drawdown off earnings. And then we got the spring, the back test to spring at the top of the range. Now we are getting the top of the 50 and 20-day moving average. We had triple bullish divergence going into the pattern completion zone and the second low, guys. That is exactly what you want to see. And I think Fastly is primed for much more upside. So definitely throw this one on your list if you've never looked at it. But back to CHEWY. If we jump back to the daily chart, guys, I just want to, or we are there. I just want to kind of say, I don't know where it's going to go from here. Obviously, I'm not a fortune teller. You very well could hold these levels. You very well could break through them. Right now, I'm not a buyer because there's no signs of implying upside. You had your first low, or your first high, then you had a lower high and a low, and then a lower low. And, you need to make something happen right here. You need to find support, you need to bounce, and you need to start moving up to the upside. I'm going to wait and set an alert down there at the $40 level to see if it goes down and forms that bullish Gartley. If not, then I'm not a buyer. That's my thoughts on it, guys. Let me know down in the comments, though, what you think. I totally respect whatever you think. If you totally disagree with me, that's fine. But that's it for today, guys. Thank you so much for watching. I really appreciate it. Come join us at the Patreon if you want to be part of an amazing family. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. And I'll see you guys in the next one. Peace.